Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I am CEO, founder, and I must say, friends of a man who, while mortgage rates go up, the only thing that happens to Corey is his rate at which he comes up with good ideas for the podcast also go up. Glad you could be here with me, Corey.
Oh man, I was talking in the 80s, but if I had some of the education back then, fully grown, that was my time. Maybe we're back to 12% rates.
Oh, don't even say it. Don't even say it. Oh, I remember that. I remember being a kid driving past the bank, and the CD rates were on the high end little light bulb signs. Like when those were coming out, they were like, show the temperature, and then it would switch to CD rates. And temperature and CD rates. And a cold day in Colorado, it would be like 6.6 degrees, and then it would be like 6.6% interest. Well, I'm kind of psyched about our kind of two articles we're going to talk about today, and also talk about just some general knowledge stuff around real estate, because there's some unique things happening in the real estate market right now. We've got increasing interest rates, making homes slightly less affordable, while simultaneously having had record-breaking money printing by our government. We also have inflation that is pushing up home values, and it's like in this fight with interest rates, and that's exactly why Powell's doing it.
COVID causing people to not move, and home builders ramping down production over the last 2 years. Like it's quite the confluence. Indeed.
And I hear Quinn in the background, Corey. So if Quinn comes in the room, just put her on camera. We won't even break stride. Right. We're gonna have a baby today on the podcast.
We really won't. She's locked. I'm locked away. Safe place. It's better that way. I love her, but she's disruptive.
All right. Well, let's hit our first fun article. And this one, y'all, is out of the Wall Street Journal by Josh Zumbrum. Boy, you got to really enunciate that well. Oh, mackerel. Zumbrum.
So I just need to point out something curious that I noticed right away. Right above the name of the author is a video with a caption. And the video's title is, "Should You Rent or Buy a Home?"
This one down here.
And the caption, for me, it shows up right above the author's name. That's really funny.
That is exact. Like, here's the thing. Okay, back to just Corey and I, because this is the thing that infuriates. I don't want to be the guy that's mad every time we do this podcast, but I'm angry.
Well, you kind of do.
I know. I don't. I didn't say I wasn't that guy. I'm saying I don't want to be this guy. That literally, just between Corey and I, a website that's to give us news, to help us make dependable decisions for the rest of our life, is A/B testing how well we will interact with their other content. And I respect the game, but it is just one more example of the degree to which you have to be a discerning reader to take this knowledge in, and there is no authority.
Respectable publications like the Wall Street Journal, like, they're not even trying to trick us. Imagine the ones that are.
They're just making money.
They're just making money, which they have to. The model's changing. People aren't buying the paper in the same way. So we wouldn't be reading this article without it. But here's what's crazy. So the caption says, economists have long said that renting and investing in the stock market is a better investment than owning a house. And in 22, that could be especially true. Now, what I didn't realize at first is that it's nothing related to the article that we're actually reading. It's an entirely different piece of content. That video is standalone, but it feels like it's a lead-in, because that's what newspaper was. The picture right there with the caption, and it leads into that article. So that's issue number one. Issue number two, took me a second to realize actually, I guess the video could be giving some reference to those economists. So we haven't watched the video, but just reading that caption, there's no referencing like which economist said,
That's
it's kind of
like
a
if I
straw
say
man article.
many people say, Corey, that you're a difficult guy to work with. Many people.
Many people. And then I have to fight that, right? Like I'm not even gonna answer it. That's the way you do it. So anyway.
And if Corey said that to me, many people find you difficult to work with, I would go, yeah, I know. So,
I know.
So
they've all sent me emails.
So
right.
Here is we're going to give you the premise of this article. There is an index that's often used and talked about in the news, and it's the Freddie Mac index. And the Freddie Mac index gets surveyed twice. Boy, my voice self-muted. Twice a week. And in those times that they do their assessment is not the same as the mortgage rates that are available that week because there's over a week delay. And that used to be fine in the 1970s when mortgage rates on average went slightly above or below 7.29%. That worked. But today, and I'm going to give you guys an example from earlier this week, but let me go down so everybody can see this graph, Corey, this one here.
Oh, yeah.
So this is the Mortgage News Daily actual 30-year rates from surveys of rate locks that are occurring in real time. And then this like very boxy line, and you can see why it doesn't get updated as often, is why it's boxy. But that is what Freddie Mac's is, and it trails all the way through an increasing interest rate environment.
It's nearly always lower than what folks were actually getting right that second.
Exactly right. And earlier this week, I was talking to a client who's moving across country. So, they're not moving for speculative reasons or anything like that, but they're a little concerned because the house is getting built and they're moving across country, et cetera. And after that Fed increase, because remember, while mortgage rates are very close to the 10-year Treasury and overall interest rates influence mortgage rates, they're not like directly causative. And so Powell made that announcement of a 3/4 point increase the other day. Then I'm in the meeting with the client. And when I'm in the meeting with the client, we just Googled what are 30-year fixed mortgages today from like bankrate.com. So pretty up to date as of today, what somebody could lock at. And it was 7.5. And then after the jitteriness and the mortgage companies settled down a little, it's back to like 6.3 at the recording of this podcast. The thing that can lead people astray is if all you're counting on is what the news said, or all you're counting on is this Freddie Mac index, you might make a decision to make an offer on a house, not realizing that you don't have a loan rate that is commensurate with the kind of payment you want to make on that house.
It's also kind of like what you can experience if like life insurance. If you watch daytime TV, which it's been a while since I have, but I remember,
Dallas was Dallas your thing?
it was not.
General Hospital. Your wife's a doctor. I could see why.
I think it was. It wasn't. No. It was The Bold and the Beautiful. I think that was my jam.
I know you won't be surprised. Mine was Jerry Springer.
I have met him in person, and he's actually a quite lovely man.
Is he really?
Whatever that was, he is.
Yeah. I mean, you'd have to be. I mean, you just get all the agitation out early in his career. He's got to be the most easygoing guy ever after seeing that many people mad.
But here's what I mean is that the ads in between captions and fights on Jerry are like, $9.99 a month for $100,000 of coverage or whatever. Well, it's either, it's only for the best possible health rating in the world. Never been sick. Like, it's very rarely what anybody actually gets. Same with the Freddie Mac rate, because there's all kinds of other things that can change the equation. Like, how much is the total amount of your loan? Because if you're over conventional limits, which is different from not just state to state, but county to county, then you go to a jumbo loan, which is a whole other set of considerations and rates. You can buy points to lower your rate. So whatever that was, you could pay. I mean, insane. You can pay a lot of money to lower it way down. Whether or not that is good or not depends on your whole situation. But that, it's just looking at the news has nothing to do with what you're actually gonna going to get.
Yes.
Think about if you ask someone, this is my other favorite thing is like you're comparing mortgage providers and you ask someone for a quote on a rate and then you're like, okay, well I should find someone else. And then like a week and a half later, you ask a second person, except the first person would have given you a totally different rate a week and a half later too.
In this environment for sure.
It's day to day.
Yeah. Like, I mean, even when interest rates are way low, it's sort of like, yeah, they're 3%. And they've been 3% for like months and months and months. And now suddenly 6, 7.5, et cetera. And that leads us to the next article we want to talk about that really ties into this real estate and mortgage conversation. And it's this idea that mortgage rates are causing a lock-in effect, limiting the nation's housing supply. So, Corey, you want to take this one to start?
Yeah. So basically, the real estate market is effed permanently by everything that's happened over the last 2 years. And it's not permanently, but we have interest rates on the rise. So folks who locked in those 4%, 3%, 2%, and 2.5% mortgages don't want to lose that amazing rate. Mm-hmm. Home builders are still have ramped down in their capacity. So there's fewer new homes coming on the market, fewer people wanting to sell. So home prices are staying higher. Interest rates going higher means that people trying to get new mortgages can't afford as much house because their cash flow just went up for the same mortgage because rates are going up. So it's causing this kind of gridlock in the real estate market.
Indeed. Now,
it's wild.
And there's some positive things that are happening is, of course, normalization and expectations for what people are going to get for a home. Mm-hmm. You know, it was just a year ago, people said, yeah, I'm listing my house for $995,000 and my realtor says we're going to get bid up to 1.3. We heard that a lot and it happened. And now in 2022, people are saying, no, we need to price it below the market to get the traffic. And then we hope you kind of get one or two bids up to just kind of get you market rates. But you're not going to get higher than market now. And that is causing this lock-in that to Corey's point, builders releasing less inventory. Now, part of that is also, so today it was in the news that lumber prices just came back to their pre-COVID lows.
Oh, really? I didn't hear that. That's curious.
So now go back to when these housing starts were, so 6 months ago or 9 months ago, where the houses being sold today, you would have had to order the lumber for. So of course they slowed down.
Right.
Because their lumber prices were 2 or 3x what they were used to paying. And now as those have come back down, I think you're going to watch builders get back to work. They're going to have a little more freedom in the budget. And because the building costs will be lower, they'll have more room on the downward side to change pricing. Like you're starting to see builders offer incentives again, pay points on mortgages or whatever they need to do. So if you're somebody considering going into a new community right now, it's probably a really good idea. Just take a little bit of time and just call the builder and say, hey, you guys doing any incentives for brand new people coming in? And is there anything I can do to be a part of those incentives? If you don't ask, you're definitely never going to find out.
Now, here's the other thing I think is important about this lock-in feel that folks are getting. There is no law against you trading in your 4% mortgage that you got a couple years ago for a 7% mortgage today. And they maybe came down a little bit from 7, but they were right. There's no law stopping you from doing that.
What would be a good reason why somebody might consider that, Corey? Why would somebody dispatch of a 4% mortgage, not even moving, but say I'm going to get rid of my 4% mortgage and go with today's higher rates?
So, and I even had an example about moving too, but let's say without even moving, let's say you had a whole bunch of credit card debt at a lot higher than 7, like at 20. You could look at a cash out refinance that would lower your total rate below what it was today. Now, maybe higher mortgage than you had yesterday, but the total interest rate that you're paying just got lower. That's one thing that you could do. Now, I wouldn't do that lightly, and I would have a lot of planning going into that because folks who don't address the reason that the credit card debt got built in the first place are going to be right back in that position just a year or two later, sometimes in more debt than they were before. So you got to have a plan to follow that through and actually make it a win, not just slinging balances around.
I was going to say, because you pay off and I think good examples, let's say you tried to start a business or something else and the business didn't go as well. Now you got a good paying job and all that, but you have the leftover credit card debt from the thing. That's a good one. It's like, we got to clean that up, but it's not going to repeat because I don't have that business anymore. So that's a great one.
Folks, because of home prices going up really fast the last few years, folks were taking out home equity lines at really low rates to help with different things. And right now, the last statement you might have gotten on your HELOC might have been 4.5 or 5, but with rates going up these last couple weeks, next time you get a statement, it might be 6. It might be right. So those can be rising.
Well, yeah,
so just refinancing and locking that in.
BECU, so that's a big credit union up here in the Pacific Northwest. I was looking yesterday, and even their published rate for their HELOC is 5.99 now. So they're creeping up. But the thing that I would love for everybody to leave with today is just the idea that each decision should not be made on a rule of thumb. Don't refinance because interest rates are higher. Or don't move and get a new house because interest rates are what they are. It all comes down to your aims, what you want to accomplish for you and your family, and your own individual financial circumstances, and having a guide that's going to take you through that. Because I think it's so easy to just forget one thing. Like you did all your calculations, all that, but just easy overlook. You forgot to put in the taxes and you're in a state that has a $14,000 tax bill on that property. That'll trip you up.
Yep.
That's the stuff that we want to make sure our clients are thinking about, because getting a mortgage in a higher interest rate environment is just another financial tool that just matters how it integrates in your financial picture. It's not a good tool. It's not a bad tool. Good or bad is only going to sort itself out as whether or not it gets you closer to your aims. So,
well, look, spending less on your house may not be part of your aims.
Right.
Like, you can pay more for your house knowing that some other parts of your life are going to be better off, and that may be a good part of the equation. You're allowed to make that choice. But here's another one. Let's say you have a big house at a 4% mortgage, and you're like, it's time to downsize. So you trade mortgages, same mortgage size, you just move it all over to less equity in a smaller house, and you're paying a 7% mortgage now. But you have lower property taxes, lower maintenance, lower just spending on everything in the house, and you got some free capital to go do something with. That's not a bad equation either. So there's lots of reasons why higher, lower mortgage rates, it doesn't really matter so much as what you're out to accomplish.
And one last fun thing we could do to tie this into financial markets is I want y'all to imagine that, let's say the stock market was down year to date. Oh, you don't have to imagine much of this. But let's say it goes down, 20%. Yeah. They're saying the Dow is now in bear territory. So do you think it's going to go to zero? No, because trends don't work that way. Certainly if they drop our taxes, I'm not going to imagine they're going to zero, nor if they raise my taxes, do I think they're going to the moon. There's like a reasonable assessment. So even if you get into a 7% mortgage now, and maybe the payments are a little bit more than what you wanted, or 6% mortgage, they're more than what you would ideally want, there will be a time in the future where refinances can occur and you will capture a tremendous amount of that cash flow on your balance sheet. And keeping in mind that fixed rate mortgages are one of the only places where inflation is helpful. Your mortgage payment, despite the fact that inflation made everything else expensive in the last year, it also diluted the cost of your existing mortgage because it didn't change.
Right.
Anyway, guys, we hope that this was useful to you guys, that you got something cool out of today, something you could take away, or something to just settle your mind a little bit around this high interest rate environment, weird real estate market that we're in. And we hope, as always, that this episode has been a contribution to you being able to design and build a good life. We'll see you guys next week.